The Office of Tax Simplification have published their second report on simplifying inheritance tax. It's focused on making the tax simpler to understand, more intuitive to operate. So it deals with the substantive design aspects of the tax, not policy. It's not like the Resolution Foundation or Land for the Many going to the heart of the policy of the tax. It's to do with the operation and understanding and simplification of the tax. So what does it cover? Interesting stuff, actually. Perhaps not as radical as some might have expected it to be, but that may have been based on a misunderstanding around what the OTS is there to do. As I said, it's there not to change policy, but to make tax simpler. So let's have a look at some of the key findings that are most relevant to financial planners. The one that's grabbed the headline most, and it is really important to understand that these are recommendations made by an important body, the Office of Tax Simplification. The Chancellor asked them to look at this. It was covered by the 2016 Finance Act saying, have a look at simplifying inheritance tax, but don't change the policy. So it's not without weight, but it isn't official government policy. They are recommendations put forward to be considered by government. Will they be adopted? Who knows? A lot will depend on who the government is. If we had a Labour government, for example, it's quite likely that they will take a much more radical approach to inheritance tax generally. And so these, in fact, all of these suggestions probably just wouldn't even see the light of day. If we don't have a Labour government and we don't have an election, which is of course what we'd need before we had a Labour government, then they may well be, and one would expect them to be looked at very seriously. Okay, so what are they? First one, the one that, as I said, grabbed the headline most, is to remove or to reduce 7-year accumulation to 5 years. There's a view that 7 years is too long. There's very little tax gathered in relation to the last 2 years, and taper relief is very difficult to understand. So proposal 1, reduce accumulation from 7 to 5 years and get rid of taper relief. Associated to that change is to remove the so-called 14-year gift rule. So when you look back at a gift that's been made within 7 years, possibly in the future to be 5 years of death, then you also have to look at the gifts made in the 7 years prior to that to determine what tax, if any, is paid on that gift made within 7 years of death. They're saying that's overcomplicated. Our job is to simplify. Let's get rid of that too. So that's the first 2 suggestions. Then there's a view, again quite reasonable, there's a proliferation of small annual gift exemptions. Of course, we've got the £3,000 annual gift exemption. We've got the £250 small gift exemptions. We've got various exemptions for gifts on marriage. We've got the normal expenditure exemption. View put forward, wouldn't it be simpler to just have one simple, single personal gifts allowance? That would also allow us to perhaps look and change the normal expenditure rules, which again are seen as overcomplicated. Another suggestion, if normal expenditure isn't rolled into that single proposed personal gifts allowance, is to be a little more focused around the rules applying in relation to normal expenditure gifts, and perhaps make there be a cap on those gifts, not necessarily being made normally and regularly out of income, but just having a cap on gifts set at an appropriate stated percentage of income. So changes there proposed to simplify annual gifts, maybe rolling the normal expenditure gifts exemption into that, or maybe just dealing with normal expenditure separately and treating that a little more simply and having a cap on it. What else has been proposed? Looking at the nil rate band and when gifts are made, to take a simpler approach to that rather than the current chronological approach of allocating the nil rate band and making it fairer across gifts made to use up the nil rate band. Some rules to look at aligning the rules for business relief and what it takes to be a trading business with the capital gains tax rule, so more an 80% than a 50% rule. So what other recommendations have been made? An important one is that there should be no capital gains tax uplift, revaluation on death, where the asset that has been passed on death qualifies for an exemption or relief from inheritance tax. The most obvious ones to consider there are gifts of assets that qualify for business relief or agricultural relief, or gifts between spouses or civil partners. So that's quite an important one. In relation specifically to financial services, there's a proposal that says actually insufficient life insurance policies are issued in trust, and that gives rise to unnecessary inheritance tax liabilities. Why don't we have the fact that term assurance policies, so pure term assurance without any definition of how long the term should be to qualify. Just any term assurance policy should automatically be outside of one's estate for inheritance tax. They don't state a particular methodology to achieve that objective, so one would expect there to be some form of simple beneficiary nomination which could be changed, but as I said, there's no detail on that. More important is the fact that they're considering or putting forward as a recommendation term assurance should be free of inheritance tax without the need for a trust. They also address the issue that we really need to be clearer around the uncertainties that arise when a pension transfer is made when someone is in serious ill health and then dies within 2 years of making the transfer. They're aware that there's an issue following the Staveley case. They're aware that it's caused a lot of uncertainty amongst advisors and also that it's unnecessary. So they counsel that that should be looked at and clarified. Two areas that are constantly looked at or considered but are just pushed on for further consideration by the OTS report is that the residence nil rate ban should be looked to be simplified, made clearer. It's overcomplicated, but it's relatively new, so it should be bedded in, and then a more robust, complete review of the residence nil rate ban should then be undertaken, and the same for the taxation of trusts. So that's where we are in relation to the main proposals under the OTS second stage report. We'll have to see, as I said, whether any of these do see the light of day. They're unlikely to be considered until we have some kind of outcome in relation to Brexit and some kind of certainty as to who the government is going to be going forward. Of course, we have the Fixed Term Parliament Act stating that the next election is due in May, the 5th of May 2022, but we could, of course, for largely Brexit-related, in fact entirely Brexit-related reasons, have an earlier election, in particular if there is a no confidence vote in relation to a deal that's put forward that doesn't work, or the government attempting to execute a no deal Brexit. We will have to wait and see. Out of this, in relation to the OTS report, is that don't expect to see any movement towards implementing any of these changes anytime soon. We may get a clearer picture of the direction of travel in relation to the current government in relation to these changes when we have the budget towards the end of this year.